I am totally unapologetic when I say that I believe the days of, let's say, traditional banking, meaning predominantly branch-based banking, but not necessarily, are numbered. In Tinkoff, we had 15,000 when I left in the spring last year. 15,000 reps approaching 1 million meetings per month. Just think about that number, for onboarding customers. And delivering around 600, 700,000 cards per month. Incumbent banks should do what they do well, which is financial services, and they should do it a lot better.
There's about 400 odd digital neobanks globally. There's only 5% of them who are profitable.
So financial inclusion should be for the state, it should be for charities, for NGOs, whoever, not for a business that is building a sustainable,
profitable
bank.
business.
Yep.
I want to welcome you to the second season of Couchonomics with Arjun. Join us this season as we go beyond FinTech and payments and embark on the journey into the future of financial services, a future which will be shaped by existing and new developments in technology and innovation, including and not limited to the likes of embedded finance, open banking, ESG, various versions of metaverse, decentralized finance, digital currencies, and other trends. On the couch, we're going to have the most influential and progressive-minded founders, executives, investors, regulators, innovators, and industry commentators from across the MENA region and beyond. Join us as we unravel a multitude of layers of the financial services industry and try to learn how technology will continue to impact the world that we live in. Couchonomics with Arjun is proud to collaborate with some of the most respected and innovative names in the world of payments, fintech, and technology. Arjun is a reliable end-to-end payment solution that provides innovation and flexibility to help businesses achieve their ambition faster by turning payments into a strategic growth driver. Get everything you need with 2U, a Saudi-based super app for delivery, mobility, on-demand services, and a lot more. 2U connects you to everything you need to enrich your daily lives by building an ecosystem across its end consumers, merchants, and reps. Visa is a world leader in digital payments, with a mission to connect the world through the most innovative, convenient, reliable, and secure payments network to enable individuals, businesses, and economies to thrive. Jidea is a leading fintech and payment solution provider founded in Saudi Arabia, expanding rapidly across the region with established operations in UAE and Egypt. Jidea's vision is to empower merchants with the tools to start, manage, and grow their business. M2P pioneers next-gen fintech through innovative offerings across payments, lending, and banking landscapes. Their comprehensive tech stack powers end-to-end banking services, BNPL, customized credit cards, prepaid cards, and more. Hello, everybody. Welcome to Couchonomics with Arjun. I'm your host, Arjun, and I'm joined by Oliver Hughes today. Oliver, till very recently, was the CEO of a Russian digital bank called Tinkoff. Tinkoff, in my humble opinion, is not just one of the most progressive digital banks in Russia, but one which is globally acclaimed. And ask any other fellow management consultant, and if they were ever talking about banks and how banks have evolved their models over a period of time, Tinkoff is usually at the top of the list. So with that, I wanted to welcome Oliver to the studio and ask you the corny question. Are you comfortable on the couch?
I am extremely comfortable on the couch, and thank you for the warm words, Arjun. That's really nice of you.
No, it's great to have you here, and I would have reached out and said hello, so I think we will try and still do that. I think you're tall enough. Great to see you.
Likewise. Thank you.
Oliver, there's a lot. We met recently, right? I think we met maybe less than a month, maybe 6 weeks ago at a roundtable conference, which is organized by FinTech. I told you it was a fanboy moment for me because I'm a big fan of Tinkoff. I sort of feel like, without having ever banked with Tinkoff, I've banked with Tinkoff, right? But no, it was great meeting you. And then, we had a couple of meetings after that, a few cups of coffee. And then I requested you to sort of come onto the show, and you were kind enough to join us. So, as I said, there's a lot of ground that I'd like to cover. Unfortunately, we have only about 45 to 50 minutes. So I want to kind of break down the discussion into sort of 3 or 4 parts, right? I want to start with your view on digital and neobanking, right? Globally. I am particularly interested to hear a first-hand view on the Tinkoff story, especially since you were with them for 15 years. I then want to dwell a little bit into the sort of evolving banking financial services space where, the new breed of competitors, whether they're telcos or otherwise, who are entering the market, and whether that's an opportunity or a threat to both the digital or the incumbent banks. And while we're actually talking about all of these things, we will pepper some personal sort of questions around, because I'm actually particularly interested in the sense that why did you choose the UAE as the the next destination in your sort of career? So with that, let me ask you the first question, 100,000 feet view. What's your view on digital and neobank globally? What trends are going to be defining what happens in this sector going forward?
Sure. So thanks very much indeed for having me. It's a pleasure to be here, and I'm looking forward to an interesting chat. So before I answer that question, we should probably try and sort out what is a digital bank and what is a neobank. So maybe I'll throw that back to you straight away.
No, hey, I have a point of view, but I for the sake of the audience, I'd rather have you answer and give us your perspective of what is a digital bank and how is that different to a neobank?
Sure. So ping pong over. For me, it's quite simple, and I think this is how people in the Indian market would see it as well. So basically, a digital bank is a bank that has a license and a balance sheet, tends to keep stuff on balance sheet. A neobank is an institutional financial player that tends not to have stuff on its balance sheet and doesn't have a license. Will probably try and get a license at some point, or maybe has an e-money license or something like that. So that's the difference.
And like every smart person, I'll say I agree.
There you go. Excellent. Consensus reached.
Consensus reached. No, I do agree. And I think this is a question that I think in certain markets is actually quite clear. But in certain parts of the world, and specifically in certain parts of Europe, it does get a bit muddled. But put that aside. Coming back to the question, what's the state of the nation?
Sure. So I look at this in a fairly maybe mundane view. I'm not going to talk about UX, and I'm not going to talk about tech, because that's obviously a very important part of the story, and there's all sorts of trends, how AI is going to be deployed in a meaningful way in digital banking. But there's far smarter people than me who'll be able to do that. I look at this in terms of business. So I'm from a business background. Tinkoff was all about a business story. It was not just about hopefully making millions of customers very happy after the painful experiences that they'd had previously in non-digital banks or traditional banks. It was also about making money. And I think, if I think back to 7-10 years ago, the word bank, the word balance sheet, the word lending became dirty words. It became horribly unfashionable. Mm-hmm. And you couldn't call yourself a bank because you were suddenly dissed by lots of youngsters who said that banking is evil. And this was kind of spurred on by what happened during the global financial crisis. So lots of people came to digital banking or FinTech with a particular idea, which was to do things very differently, to provide a new experience. But they drove their businesses with a liabilities-led approach. So it was payments, it was debit cards, it was current accounts. Some of these players managed to scale, not that many. But a lot of the players that even managed to scale, they didn't do it profitably. And there was no focus on profitability. There was very little focus on true monetization. And the reason why that happened was because it wasn't fashionable or wasn't the done thing to offer loans or other services or products through which you could monetize your customers. So as I said, some players got quite big. Others fell by the wayside or just didn't find the crack the code. And they were fueled by private equity injections, one after another. So while the music was playing, everything was good. When the music stopped, it stopped being good. And so now you've got this business trend, which is digital banks, neobanks, fintech players with a very different approach, a very, let's say, renewed focus on business basics. So it's back to basics, and they're looking at lending products, how you manage a balance sheet, and some banking basics done in a radically different way to how they were done in the past through traditional branch-based models, with a very different customer-centric approach, but thinking about the financials and thinking about how you manage unit economics to make profit. And this is something which comes out in every conversation that I have with everybody in the fintech arena of late. And it wasn't something that dominated conversations even a year ago, to be honest with you.
I agree with you. But then let me ask a question, right? So you've opened a door for me. So there are loads of statistics which fly around, and if we could just park the difference between digital and neobanks, and let's club them together. Some people say there's about 400 odd digital neobanks globally. There's only 5% of them who are profitable. The ones which are profitable tend to be, one of sort of three types or four types, and I don't know all the four types off my head immediately, but ones which are attached to a wider ecosystem. Kakao is one example.
Sure.
One which are laser focused in a particular segment and highly differentiated.
Kind of mono-product type.
Yeah. Oak
North SME lending.
Oak North is a great example. There is obviously the bank you previously ran, Tinkoff, which successfully was able to build a portfolio of offerings on a profitable base, but then also go beyond banking. And what people don't realize is that, Tinkoff has built this over 15, 16 years. Yep. It was not something which was a couple of years in. But the vast majority of them, to be honest with you, still continue to suffer, right? Now, you take that, and on top of it, you then overlay the downward revaluations which have happened, and especially if you look westward, the revaluations have been quite severe, right? As far as, in some cases, 50%, right?
That's been
right.
far more severe than 50% as
Yeah.
well in the public market. So publicly listed digital banks have really been hammered because the public markets.
I'm talking about the privately listed ones, right? Do you really see that there is a future for that many pure play digital banks?
Sure. So I absolutely do. I am totally unapologetic when I say that I believe the days of, let's say, traditional banking, meaning predominantly branch-based banking, but not necessarily, are numbered. I didn't enter a branch for 15 years, all the time that I was in Tinkoff. And I actually quite resent the fact that I'm made to go to a branch on a regular basis for very basic banking things in UAE. So this is still the model. You can't figure out online. Send the bank to the branch, the customer to the branch. So that's kind of like the default mode to do banking in UAE and many other places in the world still. That will definitely go over time. So the problem hasn't been with digital banking. So digital banking as a concept, I believe, is the future. It's only still starting. It's at the beginning of its journey. I believe it will accelerate over time. The problem has been with the way the digital banking concept has been implemented in execution. And as I say, so because of this private equity fueled, let's call it a bubble, that has happened in fintech and neobanking, digital banking, there just hasn't been the discipline that you need in order to run a balance sheet business. Banking is a balance sheet business. What I say is quite retrograde. It's very unfashionable, but this is what it is. If you can't run a balance sheet, then you shouldn't be doing digital banking.
You shouldn't be doing banking. Okay, so for example, let's assume that digital banking has a future, and I agree with you, it does have in the future. Then what's your take on digital attackers which are launched by incumbent banks, right? Yeah. Do you think that they have a better chance of succeeding versus the ones who are purely, digital banks, and they don't have that sort of pedigree or that sort of, big daddy sitting behind, or big
So I hope I'm not going to say something out of turn here, because I'm sure there's lots of people in your viewership who are working for incumbent banks who have digital offshoots. But I think the short answer to your question is no, they don't have a future. And I'll explain why, because it's a horrible overgeneralization, and I apologize for making that comment. So there will be digital sisters, cousins, daughters of incumbent traditional banks that make the journey, exactly the same as there will be digital, let's say standalone digital banks who fail to make the journey. But generally speaking, in my experience, I can't remember a single, what did you call it, a disruptor?
Digital attacker.
A digital attacker, so by that you mean an offshoot of an existing incumbent bank. Nothing springs to mind where this has actually worked. Certainly not at scale, unless you're going to correct me. And I wish them all very good luck. So why hasn't it worked, in my view? So all of this is not about your tech. It's not about your interface, about a nice mobile app. It's not about even probably your service, although service is hugely important in this. It's how you think about the customer, but it's not about that. What enables you to deploy all of that, the service, the tech, the mobile app, and a new product, whatever it might be, is the organizational design. So if you have an incumbent bank that is evolved over, in many cases, decades, sometimes centuries, there's a certain way of doing things which has been shaped by the shareholders, by the team, by regulation, by the market, but also just a mindset which has arisen over time. And that mindset tends to be transplanted into your, let's call it digital daughter for shorthand for ease of argument, because it's still under the same roof. So typically a digital challenger, if it's an outgrowth of an existing bank, it's parked underneath the CEO of the bank or the board of the bank, or maybe a digital officer, chief digital officer, whatever that means. Again, sorry for that. And so all of the behaviors, the culture of that incumbent founder is transplanted into the digital challenger.
But if I solve for the culture, it succeeds?
Well, how are you going to solve for the culture when it's the same people? So let me just qualify
I can carve
that.
out.
Right. So even if you carve out and you get a new leadership, a new team, create a new culture, you get a really nice co-working space with all the cuddly teacups and sofas, beanbags and whatever. You try and create the right environment for that digital challenger to survive. It's still subordinated and subject to the rules that are set by the parent organization, which are the same compliance, risk appetite, speed at which you can operate. So I have grave doubts as to whether it's a viable model, but I'm willing to be convinced otherwise when I see a successful case.
Okay, but then that begs a very big question, right? So what do the incumbent banks do? Do they reinvent themselves from within? So JP Morgan, for example, right? Arguably the strongest bank in the world today, right? It has a technology budget which would be greater than, 100
GDP
FinTechs.
of many countries, yeah.
Exactly, there you go. That's a better one. That's a better comparator than the one I had. So what do banks like those do? Do they reinvent from within?
Yeah, absolutely. And I've seen successful transformations from within the institution. So again,
don't they have
I think the jury's still
mindset
out.
Then?
Well, so I think the jury is still out as to whether you can not change the incumbent and create a digital system, yeah, and that be successful. So if I see one, then I'll take my hat off and I'll eat my words. So far, I haven't. But I have seen successful, for want of a better term, digital transformations inside incumbents. So one example that I know very well that springs to mind, and I think many people will know about this in terms of your viewers, is Sberbank. So Sberbank, 15 years ago, was a monolith. It was the largest state-owned bank in Russia.
Right.
It was a terrible player, the most appalling service you could possibly imagine, awful culture, horrendous management. It was changed by a new team that came in, actually consultants, McKinsey, who were brought in by Herman Greff in Russia. And they changed the organization from within it's still a journey. It's still presumably going on. I'm not in Russia, so I don't know what's happening now. But they really, as they, in their own words, taught the elephant to dance. JP Morgan, Goldman Sachs to a certain extent, because they're building a retail bank themselves.
Well, they were.
Say again?
They were.
Have I missed something? They're not
Yeah,
doing
yeah.
it anymore.
They're
stopped.
serious doubts now.
Right, okay.
With markets, right?
But there are cases where it's worked, and so I wouldn't throw the baby out with the bathwater and say incumbents can't change.
Okay. Interesting, because this is a dilemma which I whichever way you look. So in the current environment, the incumbent banks are doing fantastically well,
Sure.
right? The digital banks are sort of kind of imploding upon themselves, the vast majority of them, with all due respect. I do agree that the digital attackers have really not seized the moment. The few attempts that have been done have been either bleakly executed or poorly executed, and therefore what's come out of it is nothing more than just a lot of money wasted. And yes, there are certain banks who are trying to reinvent themselves from within themselves. I personally feel that the issue is that their own digital transformation processes are programs are so long that by the time they get to what they're transforming, the world outside has changed again. So you're constantly then in this flux of change. Right, I do think that.
But digital banks are constantly changing as well.
I mean,
Tinkoff had legacy, which it had to replace because it was so old.
Agreed.
So it's an ongoing battle which never ends.
I agree with you. I think one option which banks will be considering is that in certain areas, rather than doing the digital transformation themselves, they could possibly be acquisitive. And they could go out and buy fintechs which augment a particular side of the business, and that happens much faster, arguably, than reinventing themselves.
For sure.
Come back to digital banks for a second, right? So we assume that digital banks will prevail for all the right reasons, because they have a customer first approach. They engage the customer in a manner that consumer wants to be interacted with. Now, a couple of areas that digital banks have focused have been the underserved, or what you might refer to as the underserved, right? I'm not necessarily saying the underbanked, but the underserved, and also the segment which is financially excluded, right? Now, excellent, but the challenge with both those segments is that they're typically not as attractive financially, right? So do digital banks position themselves in a manner that they come into a market, target on segments which are typically ignored, get sort of some traction there, then expand into the area where it's a bit of a red ocean? And if they do that, then how do they sustain that sort of unprofitable period, if I may call it that?
Sure. So this is a bit of a question that lots of people struggle with, and I'm unashamedly from a business background, as I said, yeah. So you're building a business. You're building a bank, what will ultimately become a bank if it doesn't have a banking license from the beginning. And it has to have a healthy balance sheet, healthy economics, has to be self-sustaining in terms of capital generation, because banks are about capital. It's the building blocks with which we work in order to build banks, yeah, and build banking businesses. So if you can't generate your own capital, then you shouldn't be running a bank, ultimately, yeah? Mm-hmm. So this comes down to profitability. If you deliberately target, let's say prioritize financial inclusion as a privately funded business, then it could well take you into difficult waters quite quickly, because if you're lending to that segment, because it's a difficult segment, there's lack of data, it could be very difficult in terms of collections, then you're going to burn in terms of risk. If you're doing, for example, a payments business, then maybe, there's some segments that work, for example, remittances, but if it's cross-border, but if it's inside a market, then typically speaking, you're getting customers who are doing very small tickets and giving you very small ARPU, or revenue per active customer per month, and so you're going to be scaling your losses, and on the list goes. So you have to find a viable model with a viable segment that can be scaled viably before you start thinking about financial inclusion. So financial inclusion should be for the state, it should be for charities, for NGOs, whoever, not for a business that is building a sustainable,
profitable
bank.
business.
Yep.
Interesting.
I hope that's not too
No, it's not
tough, but that's how it works.
So you're basically saying what I guess crosses every CEO of a digital bank, which is, do I go after the so-called most profitable segment, but then everybody else is there.
Right, but sorry, there's a very important caveat to what I've just said, which is that as a digital bank, and we're talking about digital banks, you are, by virtue or by the very nature of what you're doing, you're driving financial inclusion, because you can work with customers geographically independently. It doesn't matter where they are, yes? So you can reach the rural areas, the islands, the small population centres, the villages, because you don't need infrastructure and branches to do it. You are not bothered about their income segment, their social status, etc., etc. So you are an institution that can drive financial inclusion just by what you do, but you have to get your story straight and your economics right before you do that. That's basically the point I'm trying to make.
So you're basically saying financial inclusion is actually an outcome rather than something which you say you are going to target.
A strategic target, absolutely.
Yeah.
Yeah. That's exactly what I'm saying.
So I get that.
Unless you've got an NGO chucking money at you, the World Bank saying, go and do this, Grameen or whatever. Yeah,
exactly,
sure.
Right? Exactly. Having said that, there are certain banks, right? So if I know Oak North's strategy well enough, not that I work with them, but I know a few people there. They did take on the challenge of solving the problem for SME funding.
Sure, but they were a business. They were run as a business. It was a very profitable business.
Very profitable, but typically went after a segment which most of the other banks were ignoring.
In a highly developed market. So I would say that's probably not a very applicable
So why weren't the
example.
other banks chasing that very segment?
Because it was small, it was difficult for them, and they did a poor job of it. So they rode roughshod over small businesses and overcharged them and gave them terrible service in the UK, which is why Oak North came along.
And yeah, I agree with you, right? And they were not focused enough. So let's talk a little bit about digital banks. And so banks always keep, every time you're talking to a bank, one thing you always get thrown in your face is, the reason we can't do half the things is because, we have regulatory challenges. We need to protect data privacy, right? We have to keep everything safe and secure. It's no different for a digital bank,
Sure.
Right? So are there any unusual challenges that digital banks face across those spectrums, which an incumbent doesn't as much?
So I think here you have to divide this probably into two regulatory spaces, yeah. And here I'm answering the question, but I'm also kind of venturing an opinion here. First part of the answer, it's all highly specific to the country in which you work.
Sure.
So there's a regulatory framework which is different from country to country. Consumer behavior is very different, competitor environment very different, etc., etc. So every single instance is different. So there's 200 answers to your question. But there probably are some fairly obvious challenges which are common to all digital banks. So it's things like KYC, cybersecurity, all this kind of thing. So in terms of that kind of regulatory challenge for digital banks to overcome and work with, there's definitely ways you can work with this. So you can sort this out through technology, superior onboarding processes, frictionless account openings, superior service. Mm-hmm. It's all about service at the end of the day. And so this is where digital banks are very well equipped to overcome these, let's say, difficulties that face everybody, because everybody in the market has to deal with the same regulatory stuff. And actually, there's a very interesting example from my Tinkoff background, which comes to mind, where in Russia, although it's a very progressive market in terms of regulation, it really is way ahead of the curve. In order to open a bank account as an individual customer, you still have to go through KYC, physical KYC with a physical meeting.
So you need vetting.
Yeah, so
and
you have to have a wet signature on a bit of paper with a passport check. It's quite incredible. And so this is obviously, if you're a digital bank, a little bit of an annoyance. It's a whole load of cost, etc., etc. But we found a way to make it into a service and actually turn it to our advantage. So we created what we call reps, representatives, who went out into the field. So you apply online through your mobile app, online web form, and you make an appointment for our rep, as it was then, to come out to you wherever you want, whenever you want, and do the account opening procedure. It's also additional credit checks, so it's useful for the digital bank. It's a great service. It's additional cross-sell, Q&A, etc. So we turned this whole thing into something that's an advantage to us, and actually, sorry for this very old-fashioned term, delighted the customer, because it's not like in UAE where you order a card and maybe they'll bring it the next few weeks and you have to stay at home for 24 hours if you get it. Sorry about that. Jibe, but it's true here. It's very painful. In Russia, in Tinkoff, we had 15,000 when I left in the spring last year. 15,000 reps approaching 1 million meetings per month. Just think about that number.
Wow.
Yep, for onboarding customers. And delivering around 600, 700,000 cards per month. You choose a time band of an hour and you would get the card.
Not the 4 hours here.
Absolutely. So anyway, so that's just an example of how technology, use of data, and just a creative approach, thinking outside the box, can actually turn all that to your advantage. But, and this is where I'm venturing an opinion, fintechs should be subject to exactly the same, digital banks specifically should be subject to exactly the same regulation as all banks, in terms of balance sheet management, capital requirements, liquidity, and all the rest of it. So there should be no exceptions made. But in terms of KYC, onboarding, fraud management, whatever, that sort of thing, maybe central banks should be more willing to give a little bit of leeway to new players to just try out new things outside sandbox in production, because I'm not a great fan of sandboxes.
That actually, so you answered the question, because I was going to ask you next is, what do you think the central banks can do to actually make life for the digital banks a little easier, and making that life a little bit easier, make them more competitive?
Yep.
And
so that they should allow experimentation, which they're actually very reluctant to.
And especially on the front end of the customer process, not necessarily in the back end.
Absolutely.
Of the way the bank is run, because I do appreciate it, because on the back end, at the end of it, it doesn't matter if it's a digital bank or a traditional one, you're holding someone else's money, so it should be...
So no leniency for the balance sheet stuff.
Totally agree.
But the ability to experiment and a little bit more permissive when it comes to the front end stuff. That's really a nice way of putting it.
So we've flirted with Tinkoff already. I'm going to ask you the obvious question. I think, if I'm not wrong, you joined Tinkoff in 2006.
2007, yes.
That's right, 2007.
Just starting.
Right. So over a 15-year period, right, paint us the transition, paint us the journey.
Sure. So it probably makes sense to start at the end, because it became quite a big financial institution. So just kind of like a footnote to this is that this was completely and utterly branchless, with 0 physical locations all the way through. We never had a branch, and I hope it never will have a branch without me now, obviously, in whatever it's doing in Russia today. So come end of 2021, beginning of 2022, it was the only, as far as I'm aware, the only systemically important digital bank in the world. So it became a systemically important bank designated by the Central Bank of Russia. It had 22 million customers when I left, and 22 million, and growing very quickly. So I think it's not far off 30 million now. It was very profitable. So it's the second most profitable fintech in the world. I think PayPal was the first most profitable, was at the time. Tinkoff made about $850 million in net profit in 2021, which was the last available numbers. And it was a full service, what we called a financial and lifestyle ecosystem. So it's pretty big, and a very cool tech company. So if you go back to 2007, the origins of Tinkoff, we actually built and launched a credit card company. It happened to have a banking license, which was very fortunate. So we didn't have to go through the pain of applying for a banking license later, which is obviously one of the problems of neobanks and fintechs now. we built a credit card company that was direct to consumer, branchless, leveraging a partner network, and wholesale funded. Then the global financial crisis came, blew a hole in the wholesale funded model, obviously, very quickly. We actually broke even after 18 months, which was highly important.
That's impressive.
And that was just at the time when the global financial crisis happened, fortunately. So we were self-sustaining all the way through thereafter. Without fail, we didn't have a single loss-making year, which is very important. And we diversified our funding model, started taking online deposits. We were the first people to basically create online financial services in Russia and some of the earliest in the world. So that took us into deposits, debit cards, current accounts. And when we IPO'd Tinkoff in 2013, we basically IPO'd a smart consumer finance play.
Yeah.
And this, basically at the time, 2013, the word FinTech didn't exist. Nobody had coined the phrase. But it was essentially a proprietary technology platform, high growth, which was consumer finance, but mainly deposit funded by that point. Then from 2013, 2014, we went into diversification. We built out lots of other consumer lending products, a big consumer payments business with current accounts and cards. We built a merchant payments business, an SME business line, a brokerage, a mobile investments company. And what else do we do? Online insurer. So basically we inside Tinkoff built, for want of a better kind of analogy, a Revolut, a Robinhood, a Stripe, and tons of other groovy stuff that we've seen over the last decade. And then from about 2018 onwards, we built out our full-fledged financial service provider for consumers and small business, small to medium enterprise. We then moved into basically adjacent verticals beyond financial services. So we had tech, we had an interface, we had high growth customer acquisition channels online, and we had the Southeast Asian ecosystems called the flywheel effect.
Yep.
So we had a viral product. We were able to leverage that to basically go into other stuff which made sense that was complementary to the business. So things like loyalty. We built a loyalty platform. We built an online travel agent. We built a virtual mobile operator, MVNO. We built all sorts of groovy
and
stuff.
why the MVNO? Just because boy was
so we were able to leverage our customer base. The mobile operators generally give a bit of a poor service, and it's a very low engagement product, or service. So how many people go into their mobile operator's mobile app? Yeah, maybe you go once every quarter, but there's no particular reason to do that. So they really struggle to engage with their customers. We were able to offer a novel product that was bundled in a really nice way that brought value to customers with our current account product. And also leverage off our distribution networks. We had these reps that I was talking about before, the field reps who sold upsold or cross-sold the SIM cards. So it worked quite nicely. Although I have to say that MVNOs are a very difficult business, and I wouldn't recommend getting into it. It's not something you should get into lightly.
Yeah, I wouldn't.
So we went into an ecosystem play.
I wouldn't advise anybody who's trying to build a super app or a platform to have their own MVNO. I think it's better just to partner with a third party.
Yep, absolutely.
It's easier.
Sorry,
I interrupt.
Yeah. So we went into lifestyle services, into this new content, which drove basically everything that we're doing in the mobile app. Drove dwell time, drove FaceTime, DAU as a percentage of MAU, which is basically a sticky factor, drove engagement. And this took us to basically a new level, which is basically an ecosystem.
Ecosystem play.
Yep.
So let me ask a question. See, a lot of people actually say that China is unique, and so therefore financial players who succeed in China are because of the uniqueness of China. Are there certain uniquenesses about Russia which allowed you to do what you were able to, which you arguably might not have been able to if you were in any other market?
Yeah, so it's an interesting question, and so I suppose part of the answer is that each different geography has its own approach. Yeah, so ecosystems don't work in Europe and the US. Yeah, so you have single use or single kind of category mobile apps, as opposed to the kind of free for all that you have everything dumped in one app in Asia.
Everything app.
Yeah.
Everything app. This week it's all about everything apps.
Absolutely. So every region has its own peculiarities. Russia had some super apps, had ecosystems. There were several of them. Some of them came out of banking. Tinkoff was the first. Some of them came out of social networks. Some of them came out of search. So there were ecosystems. But I think there are some specific things to the Russian market which facilitated the appearance of these super apps, particularly in Tinkoff's case.
And which are?
So, first and foremost, the abundance of tech talent. So, I mean, Russia has got one of the largest pools of tech talent in the world. Yeah, so some of the best engineers, data scientists, analysts, product and design, absolutely fantastic. So that's the first thing. The second thing is a scarcity of private equity and investment capital, growth capital. So it was always tough to raise capital, funding and
But how did that help?
So that actually meant that we had to become self-sufficient, self-propelling, profitable. Yeah. And we couldn't wait for the next handout. We had to be viable businesses. And if you weren't, you got weeded out very quickly indeed in Russia. It's a very punishing environment. And I really believe that makes strong companies. Thirdly, a very tech-savvy online population and a big population. So that definitely helps to scale, obviously. And probably a progressive regulator.
Okay, that's a combination. I've seen that play out in the other markets.
Sure.
So you talked about the transition of Tinkoff from largely a credit card consumer finance play, evolving into sort of a full service banking sort of play. The bit which I actually find very interesting, quite intriguing, and it's a bit of a case study for most of us, is this venture into the lifestyle section, right? So was that a pivot? Was that always the intention? Did it happen accidentally?
So it was definitely not the strategy when we started out to build a consumer finance credit card company. So over time it became our strategy for sure, but it happened in incremental steps. So I think the crucial moment, and it wasn't a pivot, it was just an evolutionary track, was when we understood that we had a viral product. So we had this thing called Tinkoff Black, which was a current account, a card, loyalty, cashback, merchant-funded loyalty.
Right.
And a really rich product, which basically achieved virality, which means it advertises itself. We got the network effect because we had a very big customer base. So I think this really happened around 10 million customers. So that means that you get kind of friends and family effect where people want to be in the same network for transferring, P2P transfers, payments, whatever. And the economics gets better as a result of that for the consumer and for the business. And so we understood that we had this virality. We wanted to tap into that in order to drive our business, which is a financial business. So how do you do that? You need to get them into your interface. You need to get them into your mobile app as often as possible for as long as possible. Why? So that you can cross-sell them other products. So this transactional product that I've been describing, Tinkoff Black, was a loss leader. We at best it was neutral P&L. At worst we lost money on it, depending on the month, and depending on what was happening to interest rates as well. So we wanted to monetize those millions of customers that we're bringing in. How do you do it? You do banking. Which is what the FinTechs have not been doing over the last 10 years. You cross-sell them credit, you cross-sell them insurance, you cross-sell them SME transactional services and lending, you cross-sell them brokerage, classic banking stuff, which I make no apology for. And a great place to do it in a very native way, and unobtrusive ways to do it in the mobile app.
Yep.
So we tried to drive engagement by offering other services which are really relevant to the customer. So relevant content it's what we used to call endorphin producing stuff. Kids, entertainment, sport, travel, leisure, shopping, offers, stuff that was relevant, really brought value to the customer and made them want to go into our mobile app more. And that's why we did it.
And use it more and use the payments more and so on.
Absolutely. Yep. So it's a virtuous circle.
And is that journey going to continue to expand, or are you guys had capped as much of a super app you were wanting to
So I haven't been in Tinkoff for a year in Russia, so I really don't know. But I can tell you that, the direction of travel, which is really quite interesting. So basically, once you get all these different services in the app, it's actually becomes quite cluttered. And it's actually rather difficult to take customers to the place where they're taking up new services. Yeah,
so what stage does it become too much and it starts becoming counterproductive?
I don't think there is that stage. Let me just explain what was I going to explain, and then we'll understand where I'm coming from with this. Not at all. So basically, there are tons of offers, merchant offers. There are tons of cashback offers, which are driven by the bank. There are travel offers, there are local events, whatever it might be, stuff for the kids, sporting events, ticketing. And so your interface is getting cluttered. There's too many things on the screen. There's too many screens. How do you navigate? And it's becoming a problem. And this is a fantastic use case for AI in the super app. So what do you do with the AI? Basically, you build up a profile based on the preferences and the behavior of the customer. And you have targeted content.
Exactly.
At the right time, delivered in the right way.
Exactly.
Very this isn't push messaging, this I'm talking about. This is the actual screen.
Your user interface is determined by
it's
who
customized
you are.
to that particular individual unit. And it's amazing. So you take the boring hygiene stuff, regular payments, transfers to your mum, bill payments, whatever, into the background and automate it in effect. You can do it through prompts, and you take the interesting endorphin-producing stuff into the foreground, which really gets people turned on. Yeah. And that's where Tinkoff is traveling now.
No, that's very interesting. Question I have for you is, what was the secret sauce, and is it that much of a secret?
So it's not a secret because I'm going to tell you now, but there was definitely elements.
Everybody note this down, right?
there were definitely elements in the Tinkoff story which made it unique. And which were really, the rocket fuel which powered this thing. So the first was real, true entrepreneurialism. So we had an amazing entrepreneur founder, Oleg Tinkov, who got this off the ground, built the original team, of which we all were part. And that entrepreneurial spirit and entrepreneurial approach permeated everything we did. We were, and the guys still are, entrepreneurs. Yeah, so that is fundamentally important. The second thing is that we had a particular organizational DNA culture, which is totally not like a bank, and actually not like anything else that I've ever seen, to be honest with you. And this culture was very special. So it was about entrepreneurialism, but it was also about deep analysis, a very rigorous, disciplined approach to running the business, using data in a way that I haven't seen other banking institutions do, a risk-taking approach, test and learn. So you have to take risks, but you have to do it in a controlled way. You have to look at the results, iterate, and then work out what works and what doesn't, and scale the things that do, and roll them out across the business. And teamwork and communication and other, fundamentally important stuff. So I had a very, very special culture. And part of that culture, this is one of the pillars, was what we call the NPV approach, net present value. So basically, as opposed to running the business in a siloed vertical economics way, vertical P&L way, so kind of, quarterly P&L results, which you tend to see in publicly listed institutions and banks. We ran our business on the basis of horizontal economics. So what does this mean? Basically, we had an NPV model for every product, every business line, every part of our operations, which informed all of our decisions. And we really ran the business based on NPV. So it's a bottom-up approach as opposed to a top-down approach. So this meant that we could delegate authority as low as possible in the organization to very smart people. They tend to be physicists, mathematicians, economists. and tech people, obviously, who took decisions low down in a very flat organization, were able to do experiments, move quickly, take risk, test and learn based on NPV, and then ramp up based on the expected NPV from a particular product line. So while we were keeping control and consistency across the organization and the discipline on focus on bottom line across the organization, they were able to use the NPV models to do what they wanted to do. And it really did work. So there were lots of, very interesting things. We were very experimental, very innovative, very risk-taking, very entrepreneurial, but based on data and very, very rigorous NPV analysis.
So you've shared the secret sauce, but trust me, it's not a dish which can be easily cooked.
No, it's not.
Right?
It took 15 years to perfect this.
A lot of these are unsurmountable tasks. So I think that sort of begs the question, right? Next, so incumbent banks, should they consider going down this ecosystem route? Should they consider beyond banking, or lifestyle banking, as you called it? Or do you think that won't work?
So I think the short answer is no. They should not embark on that journey. And the reason for that
you're
is,
not leaving these incumbent banks with too many options.
So incumbent banks should do what they do well, which is financial services, and they should do it a lot better. They should provide better service. They should try and get people out of branches, not center branches by default.
Or should they just take a step back and then ride on the fact that they've got a balance sheet and a license?
For sure.
And
provide services to other guys.
And so they should typically go down the banking as a service.
I mean, they don't like that because that makes them commoditized pipes.
Yeah, and they get
that's viable as well.
They basically get disintermediated from the customer. And to be honest with you, the customer still feels that the bank owns them; they don't own the bank. That's kind of the way it's worked. But sorry to interrupt you.
No, so I mean, let's not get carried away. Yeah. So inertia, tradition, conservatism, maybe people are just not particularly interested. Means that most customers still have their current account, their banking relationship inside a traditional bank.
Typically,
yeah,
yes.
So there's tons of fintech players, but they haven't exactly revolutionized the world. Yeah. So it's all to play for. It's only just starting. But to come back to your question. So traditional incumbent banks should not try and build an ecosystem because it requires online expertise, is very expensive. Tinkoff made loads of mistakes, and you have to have a tech culture inside your organization, which the traditional banks are just not equipped to do. They don't have the people because the kind of people that you need to build that don't go and work in traditional banks, full stop. So it'd be a painful, expensive, and a waste of time.
Painful, expensive, waste of time. Right. Let's switch to an entirely new cohort of let's call them competitors who are emerging, right? Which are on the back of this whole sort of open banking, coupled with banking as a service, coupled with the fact that the API economy is allowing you to embed financial services with embedders who don't necessarily have to be financial services. It's just that they have access to customers, they have a level of trust, right? They are potentially tech first, so they can build better customer journeys and better customer engagements, whether they're retailers, whether they're telcos, whether they're SaaS platforms, right? Are these... Well, I guess the simple answer is they're both, but I want to see where you lean more on. Are these players who are actually allowing for the addressable market to expand, and so therefore they are a greater opportunity for the financial services ecosystem? Doesn't matter if you're traditional or new, right? Or are they now genuine threats that the financial services sector, again, whether it's incumbent or digital, should be very concerned about in terms of them taking away or, large swathes of customers, possibly cherry picking.
So this question is as old as the hill. So I remember when I used to work for Visa, Visa was worried at one point about telcos coming in and eating their lunch. So let's face it, the telcos have not exactly done a good job of trying to disrupt banking.
They have done a good job with telcos.
Well, let's leave that aside. Because sometimes their approach to customers and service leaves a little bit to be desired. But anyway, So
it's not just telcos. I want to go a bit beyond telcos. I think there's SaaS platforms, there's retailers that
understood.
Yeah.
Understood. So I mean, let's take two things that I think are kind of obvious, low-hanging fruit in this conversation. So the first is telcos, and the second is probably big tech. Yeah. So who is likely to make a move? I don't think it's retailers. Who's likely to make a meaningful move into financial services and start taking away from banks, be they incumbents or digital players?
Be careful next time you go to Walmart.
Yeah. Sorry, guys. And I do not see that coming from telcos. And I've seen telcos try to make moves into financial services many times. And the reason why it hasn't been successful is because they have a very mobile-centric model. They think of financial services provided around the mobile account, and it doesn't work. Customers don't think in that way. Yeah. And so for low-ticket, I don't know, micro-purchases, it might work. But for proper financial services, it doesn't work. That's one of the first reasons. Second reason is they have a particular organizational design which doesn't lend itself to financial services. And the third reason, probably the most important, is that they overvalue their data. Telco data is actually not that good. Sorry, guys. Again, probably speaking out of school, but it's far inferior to the data that banks actually have.
No, totally. It can enrich a data set, but by no means is it comparative.
So they think that they've got the best data, and therefore they can go and build financial services and kill everybody, but it doesn't work like that. So I am a little bit cautious about the telco's ability to really invade the territory, the turf of financial services. Big tech. So big tech, I don't need to list all the advantages that they have. They're kind of pretty obvious, and that is definitely a source of existential threat over time. But you look at big tech, and possibly with the exception of Apple, nobody's actually made any inroads there either, despite quite a few attempts in the last 10 years.
Let's give Amazon its due. Amazon has not done it overtly, and I'm sorry, I'm not disagreeing with you, but I think Amazon, in all intents and purposes, has a full range now of products.
Sure.
I know Shopify is not big tech, but comes with that sort of tech background. I think, if I'm not wrong, Shopify now generates greater income out of Shopify Capital than it does out of their base platform.
Fair play.
So there are some.
But that's within a particular ecosystem. They haven't moved out their ecosystems yet.
Yeah. And there's one other point I should say. In Shopify's example, they actually partner with banks.
Sure. So they leverage other banks' balance sheets.
Yeah. And actually, if I again, I haven't done the analysis. They've actually grown the target addressable market for some of these banks because they've been able to bank some of these merchants who typically banks would not have touched.
Sure.
But now, because they're on the Shopify platform and they have access,
they get a turnkey solution.
So cost of customer acquisition is lower, cost of collection is lower. You get some data points. So therefore, why not service them?
But they haven't gone into their own balance sheet businesses.
No, they haven't. None of them. Yeah,
and the reason why they haven't is because they're terrified of regulation, quite rightly so.
Yeah.
They're worried about, let's say, what they perceive to be the toxicity of some retail financial products. And they're worried about, reputational issues around that. They're worried about balance sheets. They're worried about capital-heavy businesses and what that'll do to their multiples in the public markets, et cetera, et cetera. So
I also
they haven't made a move.
I also think you don't need a cow every time you want to drink a glass of milk. And but the point the question to me is, if this trend carries on, do banks then have to accept the fact that they will continue to get disintermediated? The TAM might grow, right? The balance sheets might grow, right? But then they are not the same banks which have existed with consumer brands or SME brands. Because if you're today a merchant sitting on a Shopify platform, who you really deal with is Shopify Capital. And there's a half dozen banks behind it, but
sure,
they're anonymized to a large extent. Is that an existential threat to banking over a 20, 30, 50 year period?
I don't think so.
You don't think so?
I don't think so. Because you're talking about a B2B business model.
Yeah.
I don't think the B2C business model will move to the tech companies or the retailers. So there could be a B2B2C model where you've got the balance sheet from a bank in the background and they have been disintermediated to a certain extent. But if the digital banks start doing, who are just by virtue of who they are, they're D2C players. Yeah, they go direct to consumer through mobile channels, whatever it might be. If they get their act together and really start doing, again, sorry for this, what Tinkoff's done and what some other banks, for example, new banks seem to be doing in Brazil and various other players in different markets. If they get it together, they will be the challengers to the incumbent banks, not these players who are coming from outside of financial services. That is my fundamental belief.
Okay, so
because you're running a balance sheet. Running a balance sheet is a difficult thing.
I totally agree.
It's something that people have completely underestimated,
and
misunderstood, and much
100%
maligned.
agree with you. And it is a very complex thing. And actually,
as we've seen recently,
exactly. And managing regulators is not the easiest thing in the world, and staying compliant isn't the easiest thing in the world. So if I was to try and summarize as sort of 45 minutes of conversations right now before I ask you the next question, here's what I've heard. Right. So digital banks came around. They were fueled with lots and lots of money. Profit was nowhere in the priority conversation. They overextended themselves. The tables turned on them. The vast majority of them found themselves sort of short of cash, right? And so therefore you're going to continue to see demise.
They were burning money.
Right. They were burning money left, right, and center. The ones who are either attached to an ecosystem, were more focused, were profitable, and they had sort of some banking capability within them. And I think some of the banks which were digital banks, which were set up by, I think, ex-bankers, have tended to do better because, those people have brought some of those virtues, those disciplines of banking.
Sure.
Right. You don't see digital attackers as a viable model just yet,
jury's out. I wouldn't be quite
jury's
so
out of it,
categorical,
right?
but
Yeah, and largely that's because they are going to be at some level or the other attached to the mothership, and the mothership operates in a certain manner, right? And that unfortunate sort of cultural pull will determine the future, right? As far as the traditional banks are concerned, their best bet is to possibly reinvent themselves from within, right? Whether they go down a product strategy or a market strategy, that's yet to be determined. JP Morgan's one example, because if JP Morgan's able to turn themselves around, then why can't everybody else, is the question, right? A bank of that size. And as far as the non-FIs are concerned, the telcos have wanted to be banks for as long as I have been around in professional services, right? I used to work in telcos, and we used to hear about telcos wanting to be banks then. Telcos are wanting to be banks today. There are very few examples where telcos have successfully become banks or even gone into financial services. And the ones that do exist are where they've actually done a joint venture with a banking entity. Sure. Big tech, you see them play a role, right? But more in terms of an enabler, right? So your point of B2B2C or a B2B2B model, right? And if we're extending the big tech definition to include the likes of Shopify and so on and so forth. Do you have a view on Apple which is slightly different than big tech, or does your view on Apple also sit exactly where?
It's in the same vein, but Apple picked off a piece of the value chain in financial services, which was payments, sat on top of the existing infrastructure of other payment systems, and did an absolutely dog's bollock job of getting this off the ground. What they did with Apple Pay and the way they went market by market in order to get this together. I mean, just breathtakingly well executed, and they've got a fantastic business there, which they will probably leverage now to do proper banking services. But
yeah, they could, but they Visa and MasterCard gained a lot out of it, because at the end of the day, the cards which were sitting in Apple Pay were largely the Visa and MasterCards, and obviously in other markets, but whatever
they parasited the system.
Yeah,
but did it really well.
Yeah, no, they did. So, and they brought consumers back on. Right. So, to me, that sort of sums up. Now, I want to talk a little bit, for the 5 or 7 minutes we have, is about Oliver. You obviously decided to sort of move on from Tinkoff. You have, the world's your oyster. How do you land up in UAE?
So something happened in Russia and the neighborhood last year, obviously, which was the war. So I lived in Russia for 22 years. had an absolutely amazing time. Russia gave me a lot, as well as incredible working life in visa for 10 years, and then 7 of which were spent in Russia. And Tinkoff for 15 years also gave me a wife and a fantastic family. So I hope I put something back into Russia as well. It was something that I'm very, very grateful for. But things changed, and I had to leave Russia, so my time was up. And Dubai, so I like the Middle East. I spent a lot of time here for business purposes as well as pleasure. I love this neighborhood, and it's just like the right hub to come to from a logistics perspective, because I was doing a project in Southeast Asia in the Philippines, helping a team launch a digital lender, and just helping the team out for a little while in Russia in Tinkoff, just to make sure there's continuity. So Dubai has been incredibly welcoming. I love the UAE in general, and this is now my home. So I'm looking for something in this area, in this geography. Obviously in FinTech, preferably digital banking, and I'm sure there's a project with my name on it out there somewhere that hopefully isn't too far away from my new home in Dubai. But this place has really got a kick, really got an energy, amazing dynamism, and it's really going places. So I just thrive off it. It's a wonderful.
No, I think you're so right. I feel like I'm an old horse here. I'm on my 13th year. I came here for a 6-month engagement to restructure a payments company 13 years ago, and I'll be honest with you. I've seen a massive transformation. The mindset has always been progressive, don't get me wrong, but what's actually changed is that the quality of the professionals now in this market are as good as you will see anywhere else in the world.
Sure.
Right? I don't want to be rude, but 8 to 10 years ago, this was perceived a place where you came if you couldn't cut it anywhere else. Right? Now, it's kind of the top of the agenda, or top of the list of anybody who wants to make a career. And, I work in consulting. We have arguably, young, enthusiastic, hardworking, intelligent folks, invariably the young ones. As you get older, I guess you get a wee bit dumber. And they all want to come here. With every office, whenever I travel to our different offices, there's always 2 or 3 people who kind of take me on the side and say, we're interested in moving to Dubai. So I think
understand why.
I think UAE, and I'll tell you something. If I really want to put a bit of a cherry on the cake, or it's not a cake, but a double layer on the cake, or a triple layer on the cake, is what's actually happening across in Saudi Arabia. Right?
Sure.
Because that, it's a much bigger country, it's a bigger economy, and that has transformed itself in the last couple of years. And their own agenda with everything to do with financial services and FinTech is terribly exciting. So I think, and Qatar is sort of coming along, and so are the other sort of, MENA countries. So I do think that this ecosystem, which, we refer to as MENA, although I don't know where MENA starts and ends, I think is becoming quite an exciting place. So I think you have not done, you haven't made a bad choice by choosing this part of the world.
And I have to say that, Dubai is very welcoming. So it welcomes some people from all over the world.
It does.
And obviously it's benefiting from all sorts of things and just the open approach. But I know lots of people who've exited Russia over the last 12 to 15 months who've moved to Dubai. The opportunity here, lots of FinTech talent as well, not tech talent, FinTech, and all sorts of expertise that is actually coming into UAE. And I think I can speak on behalf of all of them that all of us are totally amazed and very grateful for the reception that we've had here.
And that's great,
so
because
we're going to contribute.
Yeah, and they're ready. You guys are ready to contribute, and I think there are enough people who are ready to sort of bring you in and sort of add value. But I do think the future is bright. We have a big FinTech summit coming around in May with DIFC and I think Visa being the co-host. Yep. I think that'll be an interesting event. I think I think it's the biggest show Dubai is putting together in terms of fintech and financial services. So it'll
Hope
be
I get an
interesting.
invite.
Oh, you will. Don't worry. We will go together, right? But Oliver, thanks for coming in.
Thank you so
Right.
much. It's been a really stimulating discussion.
And thank you for being candid. And thank you for taking a stance, because sometimes in these conversations people don't want to take a stance. So I appreciate you taking a stance. I've no doubt there is a digital bank or a fintech with your name against it. It'll all depend on how quickly you want to get back into the full motions. But we'll meet again. We'll talk again. But with that, I'd like to say thank you.
Wonderful. Been really cool talking to you. Thank you.
Pleasure. So everybody, that was Oliver Hughes. As we talked about several times during this conversation, Oliver was till very recently the CEO of Tinkoff Bank in Russia. He now is in the UAE, which is his new home. As I said, what I loved about this episode is he took some hard stances, and I like hard stances because they make the conversation that much more interesting. So with that, I'll say goodbye till next week.